Good afternoon, Mr. Bindra, and a warm welcome to the EPS COVID-19 Special Value Series. Also, good afternoon to all the participants. I and the entire team of EPS really want to thank all the participants for coming to the show day after day to hear subject matter experts along from the financial world. So today we have Mr. Bindra. Mr. Bindra, this is our way of showing solidarity along with you that we are fighting this epidemic together, sweeping the India and globe. We will fight along with others and come successful from this epidemic. Mr. Bindra, we have a wide range of participants today who have years of experience working for central bank, commercial banks, NBFCs, also a lot of people from the payment industry. A special thanks to members of the various press media who are also present in good numbers. So briefly, to participants, I've introduced Mr. Bindra. After graduating from XLRI Management School in Jamshedpur, Mr. Jaspal Bindra joined Bankam, what's called the Bank of America, where he, I think, spent almost 10 years. He spent the next 5 years as the in Union Bank of Switzerland as the head of business in India. And thereafter he shifted to Standard Chartered, where he remained in Standard Chartered for 17 years and rose to the position of CEO of one of the topmost international bank. Mr. Bindra, you made us proud to reach at that height in those years. Our topic of today, as you all know, is the relevance of banking in an age of black swans. Just to clarify, participants, what's black swan? Black swans here means unprecedented events characterized by severe impact, like what is happening now from the COVID virus. Mr. Bindra, banking and industry has always been besieged by black swans. There's always been something or other happening. However, this pandemic outbreak seems to be, to me, it's like an ugly black swan. Maybe it's unprecedented. Maybe the financial industry faced a similar crisis in 2008-9, with many iconic, can't-fail institutions also collapsing. How different is this COVID crisis, and what, according to you, will be the fallout in the banking sector?
Thank you, Mr. Krishna Kumar. And I would also like to take this opportunity to thank EPS for the great service they are doing by bringing each day a new subject to share and disseminate information among participants on the financial services industry. And I think this is of great help during this period of lockdown. So let me sort of lay out a broad overview when it comes to banking in relevance to black swan events. First, banking is here to stay. We've had black swan events of varying severities in the past, and I'm sure this is not the last one. But banking has stayed. It's as old as mankind and will continue as long as mankind is around. What will change is how banks play by the changing circumstances. So players will come and players will go. There will be new players, there will be new channels, but clearly banking, as we understand it, will stay. And the confidence with which I can say that is that in its purest form, the basic purpose of banking is extremely simple. It is really about accumulating deposits from the savers at a return with safety of their capital, and then deploying that in productive resources at a higher return on the basis of credit judgment of skilled professionals. And the need of those borrowers and those savers are never going to go away. So there is no reason for us to believe that banking is going to become extinct at any point in time. Of course, the way these two come together, the needs of these two are met, can be very different and has already changed several times over the years and is likely to continue to change as we move into the future. The second point to note is, before I come to black swans in particular, is that the credit opportunity in India is so huge that's unimaginable. And I say that with all seriousness, because what we always project when we look forward is the growth potential and thereby the growth in the banking business. But the best way of looking at it is how a colleague, a friend of mine who used to run Hindustan Lever at one time told me. He said, we don't talk about our market share in the shampoo market by the number of shampoos we sell versus what is totally sold in the market. We count our market share by the number of hair wash that is potentially happening and the number of shampoos we sell. So we are always on a very small market share. And I think the same is true for banking. I mean, there was a time not so long ago before the Jan Dhan accounts came in that there were more mobile phones in India than banking accounts. And banking is hundreds of years old, and mobile, as we all know, is a very recent phenomenon. But even today, the unmet demand and the underserved demand in the credit market is so large. In fact, there is official data to suggest that of all the registered MSMEs in India, only 10% are able to avail credit from the formal sector. 90% rely on friends, family, etc. So there's a huge, so growth is a pure bonus. If we can just meet the existing demand, that in itself is a huge opportunity for a long time to come. So the lack of credit penetration and at the same time, the growing credit appetite of the consumers is a great combination. And then on top of that, you put the size of the country. I mean, credit business, there's a huge recipe for success. Black swan events obviously are getting more frequent, more impactful as well. If I just look at this century, the last 20 years, we had the dot-com bust. We've had several crashes in equity markets based on algorithm triggers. We've had tsunami and other natural calamities. Of course, we've had the global financial crisis of 2008, 2009. We've had SARS, Ebola, and COVID-19, the current pandemic. Besides all of these, the banks also suffer on account of trade wars, geopolitical tensions, etc. So we've had, the banking sector has had its share of challenges. And the banks always take a hit, irrespective of how well the black swan event is managed. Because without doubt, all black swan events have an economic fallout as a consequence. Yes. And banks always have to have a share of any economic hit. That's just fundamental. If we look at the most impactful black swan event in recent memory, I think it will be the global financial crisis of 2008, 2009. And just some very top line obvious consequences of those were failure of many financial institutions, Lehman's being, of course, at the top of the list. Several consolidations, again, Bank of America, Merrill being just one example of being on the top of the list, but several consolidations across the world. Several shrinkages in size and scale of operation. Deutsche and Barclays come to mind straight away. Recapitalization across the banking sector globally. Fortunately for us in India, the impact of the GFC was far more limited. We were far more protected from the consequences of that. But the one universal outcome that has come across the banking industry, across the globe, is the emergence of regulatory compliance as a domino function in the banks now. And I think if we would just take away one thing that has changed dramatically, that is what it is. And if we go back to a pandemic which happened 100 years ago, the Spanish flu, the big dramatic change, and this I'm only talking about just from a banking sector of the GFC. But if we go back 100 years to something similar to what we are experiencing now in COVID-19, there the fundamental change was that women, because so many men got impacted and the productive workforce got lost, that women were for the first time inducted into the formal workspace. And it's hard to believe today that 100 years ago, women were not given a place even in the developed world in the working space. But yes, that is a fundamental change that took place. And I think only time will tell us what may be a fundamental change that happens as a result of COVID-19.
True. Very well explained, sir. Thank you so much. So, you talked about banking, and you said that no matter how many black swans come, banking is here to stay, and that's true. But my question to you is, sir, is the traditional banking going to get disrupted, or it is the moment of what we call as a future imperfect for the banking sector?
So, unfortunately, banks, the banking sector is a thankless service. And I, again, don't say that tongue in cheek. For the purpose they serve, they get very little credit. So if you look at banks, other than for their own performance, their results, their ratios, etc., their growth, they only make news for the wrong reasons. If you take a typical growth in a business entity or in a business sector, the PE firms get great recognition for timely help with those companies or those sectors. The promoters, entrepreneurs are praised for their business acumen. Managements are highlighted for their competence. Even technology in their manufacturing process or distribution or whatever, and product features sometimes get very credible mention. But banks, besides being listed on the annual report, are never specifically mentioned as instrumental in the growth and success of any company. Whereas we all know that bank credit and other services that they offer play a critical role in any business's success. Thus, banks always get the raw end of the stick, and they are mostly sort of singled out. And I'm saying this in the context of the traditional banks whose existence is being considered in doubt. Their lending practices are singled out, their high NPAs are singled out, the frauds that get committed, either thanks to the bank's laxity or the cunningness of the customers, gets heavy mention. More recently, the mention has been largely around flight to quality, so away from banks that are not considered in the same quality as the top league, and the declining appetite for credit extension from the banks. So these two are the ones that are coming into focus right now. So when we talk about banking, there is no such thing as traditional banking. Banking actually continues to evolve. There are traditional banks for sure, but there is nothing such as traditional banking. There was a time in my working life when banks only lent against tangible assets. So it was inventory, stocks, real estate, buildings, land banks, etc. And then the first time mobile telephoning came, and I remember this, I was with UBS, and in 95, we took some proposals for Swiss PTT to the banks in India. And they said, where is the collateral? Where is the tangible asset? And we said the tangible asset is minutes of usage into tariff rate. And that was obviously very alien. And now we know better that some of the traditional Indian banks are the largest supporters and financiers of the telecom companies. So all of this has happened in 20 years or so. Similarly, microfinance, unsecured lending was not something that the financial services did on a formal basis. But now it's a big industry. There are some very big players. They have great market valuation. Their experience with credit has been excellent. One of them has converted into a bank. So clearly there are evolving trends in the financial services and in the banking sector as a whole. Of course, there are banks that fail to adapt to this changing environment, the changing landscape. And for them, clearly, there is going to be an imperfect future. But I think we need to make that distinction between banks and banking. And I feel that banking will continue to evolve and grow in the right direction. But banks that don't have the right mindset, that don't have the right mechanism to cope with the changes will have a struggle in getting to a better or perfect future.
Perfect, sir. I think well said. It's all about changes and how you adapt to those changes. That's what makes any organization, fit for the day to continue business. So besides the Black Swan events that we have spoken about, there is also, I think, a couple of factors that come up. One is the technological advancement, fierce competition between the banks, and also the customer dynamics, the customer behavior. How should banks define the challenges posed by the rapidly changing environment of technology, customer behavior, and competition?
Okay, so I think, we've had Black Swan events over the years. We've had competitive dynamics which have changed. We've seen customer behavior change dramatically. We've seen the advent of technology and now it advancing to, AI, artificial intelligence, transforming to blockchain technology. So I think there is a lot that has been moving. And actually the banking sector itself, outside of these dynamics, have also transformed quite dramatically. So if we go back to pre-independence days, say 100 years ago or so, banks were largely private owned. They were owned by royals, they were owned by big business houses. There were a handful of foreign banks that were operating in India much before independence. I can talk about two of them who I was personally involved with, not pre-independence, but more recently, but have a better understanding of their history. So there used to be a bank in India, which was Grindlays Bank. And Grindlays Bank actually came to India only to serve the British Armed Forces, to take care of their salary payments, their remittances, their financing needs for the forces, for making their purchases, etc., travel, etc. And then came another bank called the Chartered Bank of India, Australia, and China, which eventually became Standard Chartered Bank. And then I had the fortune of being able to merge the two banks, Grindlays and Standard Chartered, in the year 2000 and make that one institution. But Chartered Bank came to India to follow the East India Company and to finance its trading needs and its trading empire, build its trading empire in India. So clearly, if we go back to the pre-independence era, the banking sector was all either private or foreign. And then 1966 nationalization happened under Mrs. Gandhi's regime. And for many would argue, particularly at that time, that all for the right reasons, and for a long time after that as well. I'm in the camp which would argue even today for the right reason. And then the market share of the state-owned banks became 95%. So from a fully private foreign or almost entirely private foreign ownership, it became the other extreme of 95% all state-owned. And now if we look back 50 years later, since 1966, only 65% of the banking sector is state-owned. In fact, if you look at the entire corpus of the financial services sector, because some proportion of it has gone to non-banks now. Non-banks now have a healthy market share of about a double digit in the teens kind of market share of lending in the market. So if you take that, then the PSU banking share is even below 65 that it enjoys. So there's been a dramatic shift between private, public, non-bank kind of players in the banking sector. Clearly, the private banks have scored over the public sector banks, largely given their technology, good sales, good credit skills. And there is always a section of people who have said that if you had to compete in any one sector, do it where the competition is 100% state-owned, because your chance of success are so much higher. And sometimes that is read and misunderstood to make believe that the talent in the state undertakings is in any way inferior. Actually, I have every reason to believe that the talent in the state-owned banks and the experience and the diverse nature of the business they see is far superior to that in the private and foreign sector. But because of state ownership, they suffer from many constraints that make them less efficient. And therefore, you see this dynamics of market share play out the way it is playing out. But you then also see the non-banks taking share away from both private and public sector banks. And that's largely because they are very focused on niche plays, and they are also very committed to the last mile connectivity, which the banks sort of don't have the bandwidth for, because they just do so many other things and they are happy to do the whole comprehensive range of services rather than focus on one or two things only. But the one other thing I would say before I sort of come to the to specifically answer the question whether traditional banks are dead or alive is that people are very kind to banks. So I've just said earlier that people are not thankful enough to banks in terms of recognition, and that is true. But in real life, they're actually very kind to banks, because if you look at, and this analysis has been done several times, and every time you look at the error rate of banks, and we have huge difficulty with the aviation sector, particularly the state-run aviation sector, like say Air India. And we've done this study with Air India as a comparison, as well as with Aeroflot and as with Bangladesh Airlines, etc. And if they had the same error rate as a well-run foreign bank would have, they would have a crash a day.
Okay.
So that is the disparity. People are willing to, there is so much inertia when it comes to banking. And people are, because their money is involved, personal money is involved, personal relationships are involved, they are very happy to give it a very long rope before they make a yes or no decision on a bank or a banking relationship. So the combination of the slack that banks get from customers, and also because of the changing sort of module in the banking sector, I think banks are just given a much longer life than they were in any other sector. So that's just kind of just to give you that sense. If banks were in the aviation sector and had one crash a day, clearly nobody would be buying their tickets. But they do get a much longer lease life. On the other hand, there are some exceptional performers in the banking sector. And I think there is a myth that the old banks are the kind of traditional poor banks and they have to die, and the new generation banks are the right ones. There are some great new generation banks, and I think we all know from the top of our head, it's easy to say HDFC, Kotak, great stories, great growths, Bandhan in that category. There are others which I may not mention here, but there is a list of new generation banks that have done well. But there's an equal number of equally new generation banks like Yes Bank and IDFC who had to find new partners to bail out. So I think, it is not foregone that your vintage is what is going to make you count as traditional versus non-traditional. There is also, as I said, customer forbearance and tolerance for a lot more with banks than with other service providers. And finally, I think we are seeing in the macro position, the change taking place on its own. The giveaway of space from state banks to private banks and part of the banking services directly to non-banks. And I think we're going to see more post-COVID-19, I think, because technology, I believe, will take even more center stage than it was before.
Yeah, thank you so much. I like the idea of what you said, Ford, that banking should, if the banks were like the aviation sector, they should always be in that kind of a mode, at least. I think very true. Banks have been given a long lease, and so that's something. If they adapt themselves to the newer ways of doing business, then I think they will survive the onslaught. So sir, we also have all the participants are requested to whoever has questions, please put them to the Q&A or the chat box, and we will get across to Mr. Bindra as many questions as possible. So one of the things that a very comforting thought the governor, Dr. Shakti Kanta Das, said during the recent monetary policy that, in view of this pandemic, he said that the RBI will do whatever it takes. He said that words, whatever it takes to cushion the economic blow of the pandemic before announcing a cutback in the reverse repo. Do you see a large amount of liquidity going to industries and consumers? And the second part of my question is, what are the next steps, according to you, should the RBI take from your point of view?
So I think I completely agree with you, Mr. Krishna Kumar, that the RBI has been quite forthcoming in the way they have stepped up, and even more reassuring is their commitment that they will continue to be forthcoming as and when the need is there. However, a lot of the intent of the RBI, unfortunately, hasn't been met in the implementation because the key measure that RBI has taken so far is really generate liquidity. First liquidity directly for the banks so that they don't have any pressure in terms of dealing with the moratorium, etc., that has been extended directly by the RBI to the borrowers. But also to be able to be supportive of several sectors that may have the same challenges from the moratorium and the slowdown in the economy because of the lockdown. Now, we feel that because the banks have to also take care of their commercial interest, they are finding it very difficult to follow through the intent with which that liquidity has been earmarked. Because eventually they are responsible for being able to prove their performance to their investors, to other stakeholders over time. and they find that to be a conflict with the social purpose that is intended by the RBI. So I think that is where there is a gap. So both the liquidity and the lowered cost of funding has not yet passed on in sufficient measure to the borrowers in need. And I think that is where the RBI will have to step in. The US has done it very differently, where the Fed itself has directly underwritten the debts of the SMEs and of the borrowers, both small and large. But here, because the only mechanism, the RBI has never chosen to do this directly before, so it's an unprecedented step for them if they were to do that. So they have continued to follow the traditional path of doing it through the banks. But because the banks don't have the protection on the commercial side, they are being very reluctant. So all the liquidity that is being created by the RBI for the banks is going back to the RBI as reserves. So there is no real credit exposure beyond the banks.
Okay.
That's it.
Yeah, I think that's true. That's something to ponder upon. And I think I'm sure the government and the RBI looks at that. I also want to kind of tell that the viewer, that people who are watching this program through YouTube can also post questions to us. Please send your questions to us, and we will try and get it across to Mr. Bindra. So while we do that, so we had the IMF talking about they say that about 170 countries will have this year, because of the pandemic, a negative income per capita. It will go down big time. And just a few months ago, they were talking about 160 countries going to register positive per capita growth. And it's a big turnaround that way. So any thoughts on this? Do you think that such a lot of countries will go down from a negative income per capita?
So I think it's very difficult to predict. I think the fortunate bit is that in terms of the financial year, at least for India, given we follow an April to March year, it has come at the very early bit of the financial year. And so the last financial year has been almost entirely protected. And we are going to see most of the consequences happen in this financial year. And I don't know how bad it can get. It's definitely not going to be good, we know. But how bad, how quick the recovery, I think is difficult to say. And I think if I was to follow common wisdom, most people would say that, 2021 is a write-off. Even if things get back to operation, it will be many months before they get back to normal. And then there will be a new normal because of human behavior and the fear of this risk. Until there is a vaccine found, everything will be still extremely slow. And I agree with all of that. But I had the proximity to see the impact of SARS when it happened, which was obviously less severe in terms of spread and scale as COVID-19, but it was the most recent thing. And in the countries it happened, and Hong Kong is the country I'm talking about, where it happened, it was quite severe within that country. It was so severe that within 30 days, real estate prices fell by over 50%. And Hong Kong is a very big, rich real estate market. And it's actually one of their mainstays other than financial services. And so clearly that was a very unnerving situation. So everybody's net worth who owned property was down by 50%. The biggest listed companies in Hong Kong were property companies. Their market cap was down almost 70-80%. And clearly the government's revenue, which is also largely dependent on real estate, was going to suffer seriously because of that. But the SARS, of course, lasted its term for the 4 months or so. And then as it faded, within 6 months, things were absolutely back to normal. I mean, banking was back to normal, real estate prices were back to where they were pre-SARS, and since then have multiplied 4x. So it's very difficult sitting in this position to be able to say that, everything will be only one way and it will be there for a long time, etc. But I think if one must take a balanced view, I think it is understandable the way the IMF is putting out this big switch from 160 countries being on positive economic growth track to 170 now being on the negative track. But I think it is not so much about it's not just a simple calculation of business performance, etc. It is also what level of stimuli comes into play. I think we have seen that. We've seen it in the GFC time. The US government was very quick to act, and they introduced this TARP facility, which was really a generous liquidity spray across all the financial systems in America. And they came back much quicker than the European banks or the other banks, the large global banks that were affected. And once again, they seem to have taken a very bold, courageous move on the stimulus side. And so even though they've been quite seriously impacted in terms of number of infections and the fatality rate, it is possible that they come out of it quicker than some others. And I think that would apply even for India, depending on how it's not just the size of the stimulus, it's also the way it is administered and made available, and to which sections and how effectively to which sections, etc. And I think we could, depending on policy response, we could get a very different outcome than if one just looked at from a health point and the impact of the virus point of view.
Yeah, thank you so much, sir. Thank you very much. So at this time, I would like to open up for a couple of questions from the audience right away. May I request Mayur Shetty from the Times Group to kind of unmute yourself and please ask the question.
Hi, can you hear me?
Yep.
Hi, Jaspal. Mayur here from Times. We met a very long time back. I don't know if you recall.
Yes.
So I'm picking up from where you left on NBFCs being good at the last mile, and we've seen over the years how they've had a roller coaster ride. While they've been doing a good job on the asset side, the liability side, nobody's sure like how it should be handled. At one time, RBI felt that they should be raising their own deposits, and then it was felt that they should go to the bond market, and more recently, like the feeling is that they should be piggybacking with banks doing co-lending, and now again like they are left on their own. So what do you think from a financial stability point of view? What would be the best way going forward for NBFCs in terms of liability?
So I think all of the above, Mayur, because all the things that you said, I think the pure arbitrage model that was such a big push for the NBFCs. So if you go back in the histories of, if you go back to the history of NBFC, if you go back pre-2000 till the 90s, all the NBFCs that we see today in the form they are, were all largely broking advisory firms. They weren't really lending institutions. They were merchant bankers and so on and so forth. But I think then the arbitrage model stepped in, and they realized that they could build the expertise to lend at higher rates than what they could borrow at from the financial system, and manage those risks effectively to provide themselves a good return and also satisfy the banks, etc. So I think pure lending model on arbitrage, I think, is now less likely to survive. What will survive is that last mile connectivity strength is not going away. So I think we are going to see a lot more of co-lending. I think the co-lending was sort of something post the ILFS. Everybody felt that liquidity is tight given the bank lines were not as forthcoming and must do. But I think now it's no longer a luxury. It is a kind of a necessity. I think there will also be a lot more NBFCs having at least a part, if not a good part of their business as business correspondent for banks. So that is almost no sharing. I mean, almost 100% for the banks and just being the conduit agent for the NBFC. So I think that will be there. There will obviously be a premium for those who have more capital. So I think there will be a quest for more capital. The NBFCs have been notorious for being very thin on capital in the past, and I think that will probably undergo some change as well. But it will be some combinations of these that will take place, because you rightly put it that the liquidity side was kind of taken for granted for a long time, at least till the ILFS event, and that's not likely to continue.
Right, sir. Thank you so much. We have another question from Mr. Tripathi from ETV Bharat. Are banks ready to provide easier and cheaper credit on concessional terms to SMEs by giving loan repayment moratorium?
Yes and no. I think the answer is really a really challenging one for banks, you know. So let me put myself in the shoes of the bank and try to answer this. I think when we look at from a bank, time and again it's been proven that liquidity is key. Now, in this case today in India, the RBI has taken care of that liquidity challenge. So all the banks are now flush with liquidity. So that is not a challenge. Even post the moratorium, they are all very liquid. The second issue is earnings. That will be the next milestone that they will have to monitor over time. They'll get away for the next 6 months maybe, but after that, that will come into question. And if they are going to continue to be reluctant to lend, because on commercial judgment in this kind of lockdown environment is very difficult to make your best picks on the credit side, then clearly their earnings will suffer over time. You know, by leaving the money in treasury, they are suffering negative cost of carry. So clearly that's the challenge. And if earnings suffer, then capital will be a higher requirement for these banks. So at some stage there will be a trade-off between those two. So just like I think the best way I can put it is just like the government is in a dilemma between extending the lockdown and lifting it, so are the banks between undertaking more risk or foregoing earnings. And I think that is where the challenge is. And the way the banks are looking at it today is that if they suffer on their existing exposure, they blame it on COVID-19. But if they suffer on their new exposures that they extend now, then it is their judgment, their problem. And so I think they all have to come to assessment, each bank for themselves, is that if we don't extend new credit, then does the existing hole, which we can, the existing challenge that they have with the exposure, can that be mitigated by new credit? But if we don't give it, does that get a bigger problem? And of course, we have no earnings. Or the alternative that we extend new credit so that our overall exposure has a better chance or gets mitigated, the risk of provisions on bad debts get mitigated, and we have some earnings on it. But that's a calculation that each bank will have to make, and come out of that will be their decision.
Right. Thank you, sir. When we talk of banks and banking, one of the questions that is bound to come, and it's already come, is NPAs. It's bound to come. So will banks see a new wave of NPAs right from industries, MSMEs, and other retail borrowings in the coming quarters?
I think it's all relative, but I think there are two ways of looking at it. So I think the first is that, NPAs don't happen on day one. So, you have a delinquency and then you have a restructuring maybe, and then you have an NPA. I mean, that is how it is. And even once you provide and, you could still recover over time. So I think we're definitely going to go through a challenge where payments on time are going to be less the case than they were before. I think some sort of concessions in terms of putting good after the bad or giving more relaxation or restructuring will need to step in, and each lending institution will have to use their judgment on how they manage that. And then finally, there is an accounting process by which once you get over 91 days, and there is a lot of debate within the government or within the Reserve Bank of India, is that 91 days the right number today given what all is happening in the environment, or should that be extended to 180 days for the temporary period of time? And if that happens, then that is another sort of cycle. And then, of course, once you technically become NPA, then the recovery is then the recovery process is another process. So I think we will see increase in all these areas, in all of these paths or cycles. And I think a lot will depend on how quickly we come back. A lot will depend on what kind of packages are customized to each one. And I think some banks will do it better than some others for sure. Some sectors will come out of it better than or quicker than some others, but it will be a mixed bag. But I don't think so there's any doubt in agreeing that it will be a very challenging period for the banking sector, at least for the next 6 to 12 months. The overall consequences of it, we don't know, but the challenge we definitely know.
Yeah. Thanks, sir. I think the moot point is that we don't know what's coming our way. I think that's the future area is just something nobody can predict. And so, although government has announced a lot of steps, you never know what else and what more and many more that the government may have to do to ease the the burden on the economy and the business and the people. So I'll take a turn into technology a little bit and come back to these questions. So we've seen a surge of technology, typically from AI, robotics, and many other technology areas. Do you think these are here to stay on, and that their implementations will be much more in the days to come? And what are the kind of changes that you see from a technology point of view in the banks?
So clearly, and technology will be center stage. It already was. I think many of us in our banking careers in my case, towards the end of my banking career, we would commonly hear people say in the boardrooms that we should be technology companies that offer financial services rather than the other way around, saying we are a financial company that adopts technology well. So I think that direction has been set, and I think it's on the upward trend, and it will continue. And if it needed any validation, I think COVID-19 will now provide it. So clearly there is going to be much more digitization, both in the near term and in the long run. I feel that the fintech companies which have been sort of championing the use of technology in the financial services have been there for a while, but they have initially they were all touted to be big disruptors and would upset the old brick and mortar traditional banks. But actually, what has been seen is that the fintech companies that have really done well, grown in size and scale, are the ones that have collaborated with banks rather than competed with them. And so I think we will see that, because I find that there is an excellent cocktail between the bank's infrastructure, the bank's brand, and the trust it enjoys, and the fintech's technological capabilities. And if we can converge those for reach, for efficiency, for scale, I think that's a great cocktail. And I think that is what I see continuing to happen in larger measure than before.
Yes, sir. Thank you so much. Yeah. So would you say that it's like, are we nearing the end of the, this debate has been going on, the end of the brick and mortar branches in the near future?
KK, I don't think so, because, and I'll give you a simple test point. If you look at the United States, again, may not be entirely relevant for India, but I think I'll tell you my view on the India side as well. I think the US number of physical brick and mortar branches in the US today are more than they were pre the 2008 financial crisis. So I don't think so people are shying away from opening another branch, or for people reaching out to another branch for that purpose. So I think there is that. I think India, we're just so poorly sort of served outside of the big metropolitan towns that clearly there's room for branch network to grow for a longer time. I think the branches in the new setup are going to be more functional, smaller. They're not going to be those big intimidating branches that we were used to in the big high streets for big cities. I think that will change. I think there'll be a lot more technological interface between a branch and a customer. Even when you get into a branch, I think there will be a lot more happening in a branch. And I'll tell you that the logic is very simple. And I'll give you an example from a very different company. This is a company called Maruti Suzuki, which we all know. This is a story Mr. Bhargava told me several years ago. What happened was that about 30 years ago, they decided to have a car mela, and they chose a village in Punjab as their first testing point. This was roughly 20 odd kilometers from Jalandhar town. And they went in with a fleet of that time, whatever cars they had, the Maruti 800, Esteem, I don't know what else they had, but they had 3-4 models, Gypsy, hard cover Gypsy, soft cover Gypsy, etc. And they went in there with this fleet of 20 vehicles of different models. And they were there for 2 hours, out of which they spent an hour plus having lunch with the Sarpanch and the other seniors of the village. And they took about 40 minutes to sell all the 20 cars. And they sold only 20 because they had only taken 20 to display.
Really?
And, so the sales head asked the Sarpanch and the seniors that why come that we have a branch less than 20 kilometers away. All of these and more cars are there available for you to choose from, and more color combinations, more interior mix combinations, etc. Instead, you've just taken fait accompli whatever we brought to you, but you didn't, and you have the purchasing power. Why didn't you come there? And they said, we've seen it. We pass your showroom many times. It's a very nice, large showroom, but it's very intimidating for us. And we're not sure we are welcome in those premises, given our dress sense and all of that stuff. But here on our own charpa, in our lungi, we're very happy to be able to buy this. Our kids will love being able to be mobile. Instead of doing it on a tractor, they'll now do it on a Maruti. So I think there is something about banking which is going to change in the rural side as well, where there will be a little bit more of mobile, but mobile as in a physical mobile. And I say this also, I mean, it's the same dilemma we have, if any one of us was preparing for a surgery, and we were given a choice by the hospital that would you like to have your surgery done by a very experienced doctor, or would you like to have it done by a very well-programmed robot?
Yeah.
And I think we would have that dilemma,
Sure.
for some maybe very routine, simple surgeries, we might go for the robot. Some of us may go for the robot never, and some may go more than others. For the more complex thing, you may want, even if irrespective of who you go for, you might want an opinion from both. So I think there's a lot of advisory services which is still very much a human thing, and people don't. And I think we have to remember that many decisions people take with their banking services are some of their biggest decisions in life. So in fact, I used to say earlier when I was much younger in my career, that outside of marriage, every other decision, big decision in life is done with a bank. So whether it's buying your house, it's buying your car, it's your investments, it is your succession, for everyone, those decisions are really quite mega. When we sort of just aggregate them and talk about it as a banking industry and sector, they all become meaningless. But at an individual level, your first house or your final house, these are big decisions.
Absolutely. Wonderful. So we, like I said, we are also live on YouTube, and we love technology. We love social media. And so let me take the first question from Venkat Narayanan, who's coming through the YouTube. He asked a question: are central banks supported digital currency as a new source of disruption to the banking sector positioning and their earnings premiums? It's on the digital currency.
Yeah, KK, can you just read that again? I missed some words.
Yeah, sure. Yeah. So his question is, are central banks supportive of the digital currency as a new source of disruption to their banking sector positioning and their earnings premium?
Okay, so I think the answer is that there is a mixed response between, there is no universal acceptance or agreement between central banks on cryptocurrencies. So I think we will have to wait for that time. To me, the reason that currency is so paramount and relevant is because it is backed by a central bank. And if something is not backed by a central bank, then can it have the same currency value? Even though we've seen cryptocurrencies appreciate tons in value, but it doesn't have that backing.
So we lost you.
Yeah, so I was going to say only that much. Yeah.
Okay, cool. So that's nice. We have almost come to the 1 hour end of show, but I have a couple of questions which are like a little away from banking and financials. So we all know that the Standard Chartered Marathon is your brainchild, and that's it's taken off so well that there's a whole lot of population who looks forward during the month of January, February to participate. Yours truly, I have also participated in 2012-13. Enjoyed the public show. It was beautifully done, sir. Congratulations to you. How did you come up with this brilliant idea, sir?
So honestly, when the idea was presented to us by the organizers, they came to us. These are the two brothers who run it even till date, and they brought it to us, and they said that all over the world, marathon is a very popular sport, and we should look at it here. It has got, they told us about the numbers and how potentially it could be a very large property for the institution. And obviously, all of that came with a large request for a very large check. So it was almost an impossible thing to say yes to, because running was not in the year we started, 2003, not a favorite sport, definitely. And getting up very early in the morning was not something young people did. It was largely, a morning walk for the elderly population on Marine Drive and Worli Seaface, etc. So none of what they presented actually made any sense. And what got us thinking was that, okay, the specific property may or may not be the right one, but the idea to have a property in the world of sports, given the demographic profile of India, given our at that time the Standard Chartered's aspiration in the retail business, etc., is something we should be part of. And we went around looking for everything. So we looked at cricket, and we did a bit of cricket as well. We looked at going into something completely small and new, like rugby, basketball, etc. And then we discounted all of that. And the reason we came back to marathon was it was by far the only inclusive sport. One is you didn't need to be of any social status to be able to participate in that. You didn't need to have very much in terms of equipment, as long as you had some pair of shoes. In fact, there are many willing to even run barefoot, but I guess a basic requirement was a pair of shoes, running shoes. And it would cover a very large part of cover everyone. It was open to everyone. And I think that singular point of inclusiveness, which of course now in terms of financial inclusion has become even more relevant. But at that time, that was the selling point for us, and not so much the pitch that was made by the organizers.
Right, sir. Thank you so much. Sir, can we take one last question? I'm sure, I know it's like I'm taking about 5 minutes more of your time.
Sure.
Sure. So let's take this question from Mr. Tripathi from ETV. Can you please unmute and ask this question, please?
Okay. Very good noon, Mr. Bindra. This is Krishnan Tripathi from ETV Bharat.
Hi, Krishnan.
I just wanted to know, there was a lot of talk that there will be a fiscal stimulus. PM Garib Kalyan scheme was announced by Finance Minister Nirmala Sitharaman on 26th of March. And it was expected that there will be a stimulus within 2 weeks or so. Now it is more than 1.5 months, and from last 2 weeks, Union Cabinet has not met. What is the sense that you are getting? What is going on within the government? Why it is being delayed? And some people say that when the industries are under the lockdown, there is no point in announcing the stimulus package. Do you agree with this point of view?
There are two questions there, and I'll quickly answer them in the interest of time. The first one is that, yes, we hear from very reliable sources, and I'm active with some of the business forums that have been in continuous dialogue with the government and the ministries, that there is a package being worked on, and it's we are told, and I've been told this a few times now, that they are almost ready on the package, and it's getting its final shape. So there will be some announcement of a fiscal stimulus. Whether it will entirely meet the expectations or not is the issue, but clearly there will be a package. In terms of the timing of the announcement, I find it completely irrelevant that industries close or open, because I think the lockdown is based on a very different criteria. The economic stimulus has to be based on a very different criteria. So in some cases, the sectors affected, the challenge, behavioral change that will take place post this lifting of this lockdown will affect some people more than others, I think. So I would, I'm not very clear as to why people feel that there is no value in announcing a package. I think we've already seen that the generous announcement of the packages by US, Germany, New Zealand, etc., well before they've lifted the lockdown, have already created such a positive situation there. And companies like Hertz, Hertz is a car rental company, you will know, which was about to go bankrupt, has now got saved because of the package announced. I think several other, Boeing was going to go through a claim for bankruptcy. They have stopped that because of the package announced. So I think it will have the right impact if it is in the right measure.
Excellent. Thank you, Mr. Bindra. There was wonderful talk. We already exceeded time. I'm so sorry about it, but I think the talk was so good and the subject was also so interesting that people wanted to ask you. And thank you for staying back a little longer than the scheduled time. Once again, on behalf of EPS and the entire team, I would like to thank you for coming, participating, and answering all the questions that came across from a variety of people. And once again, I hope to see you soon, sir. Thank you very much for coming, sir.
Thank you.